the top 7 mistakes home buyers make that blow up the deal.
Without a doubt, the number one thing that I run across when new home purchases are being done would be the credit. And what I mean by that is a few different things with credit, right? So certainly running your credit multiple times. There's a lot of times where people certainly do shop around, which you're allowed to do to a certain extent. But when you start getting into, 10 credit pulls at a time, that's gonna really affect your score. You may find the greatest lender, but by the time you get there, you've gotten maybe 10 to 15 points dropped off your score, which isn't good. I'd say the other thing, this is a very common one that people do, is adding accounts, opening up new credit cards, opening up new personal loan accounts, and probably the most common one I get, which I completely understand. I actually did it myself at one point, is opening up an account, let's say at a furniture store is a very common one. They have sweet deals at these furniture places. I'm very aware of that, where they give you 0% for 10 years sometimes or whatever. But you really want to hold off on doing anything as far as opening up the account. Missing payments is another major one. You definitely don't want to miss any payments. You want to make your payments on time through the transaction. Even if, for example, one of the ones that comes up is, let's say you have another house and, you're selling that house and it's closing after the first, just because it's closing after the first and you're in contract doesn't mean you still need to make sure you make the payment until that transaction closes. That's probably my 3 top reasons as far as the credit is concerned for why a deal would blow up. So the number 2 reason I find that happens in a transaction that can blow up a deal, transferring of funds. Clients have accounts across multiple different institutions, right? So you can have a Schwab, a Chase, a Bank of America, 401k accounts, IRAs, things of that nature. There's a situation where you might be getting gift funds from a relative in which they're going to give you a part of the down payment. Why the transferring of funds can get a little dicey and tricky is in this current stage, you have to have everything tracked. I have to be able to track every dollar that comes into the transaction. I need to know exactly where it came from. If it's an account that's, let's say, overseas, which I get a lot, there are certain accounts that they don't make it very easy for you to get the information to show where it's coming from. And so if we're having parents who, are overseas are giving you money, they're transferring the money directly into your account, and then we don't have the ability to track it, and can cause a problem of us not being able to use it at all. And so you can see where this could easily blow up a deal because you wouldn't have enough money for down payment or closing costs or whatever that might be. We're going to go 60 days back, and we're going to look at all the transactions that happened in those 60 days. So the most recent 2 monthly statements from the account that you plan to use. I need to be able to track all of that stuff to make sure that I'm able to see exactly where that money's coming from. And part of the reason for this is just they want to avoid money laundering. It's part of the Patriot Act. My best advice for this particular topic is to make sure just leave the money where it is until I have the conversation with you to say, okay, here, we're going to move X dollars from this account, and here's where you're going to do it. There's also a lot shorter ways with less documentation to actually send it directly into escrow instead of having it going through multiple accounts. So we don't want to overcomplicate a glass of water here, but you just definitely want to make sure that we're having a good conversation about where these funds are all coming from. Number 3, let's talk about your job. The stage at this point of trying to figure out your income, and there are times when people will change jobs in the middle of transaction. It does happen. The key to this is to make sure that you're not changing your job from, let's say, barber to a school teacher. This becomes an issue because it's not in the same industry. You've got to have a certain amount of months in working in the same industry in order to use the income that you're newly receiving from the new job. Most of the time, that's 12 months that you'd need to have under your belt, being in the quote unquote same industry in order to use that income. So changing jobs is critical in letting me know that, hey, I'm planning to take on this new endeavor. And certainly we can get the right documentation together so that we make sure that we're tracking that and we're able to, in fact, use the income from whatever your new job may be. Also, losing your job. This does happen in a transaction. As you know, people get laid off off all the time, and so it is a possibility. Doesn't mean it's a death sentence for your loan. There's a few things that we could do. Is if you can go and certainly go get a new job within the time that we need to close. We don't need you to start the job and get a paycheck. That used to be an old rule. Some lenders do require you to have at least one pay period before the close of the loan. I don't normally need that. We just need an offer letter. So an offer letter is just going to come from your new company stating when your new start date is. It'll break down the income very quickly. We verify that, and that's it. I think that pretty much wraps up the job issue. Those are really the two major ones that you'd have when we're talking about jobs blowing up a transaction.
The number 4 thing that we see that can really blow up a deal is unrealistic expectations. And what we mean by that is, more importantly, when I'm sitting down and meeting a client, I often ask, how much money do you have to put down on a property? And what is it, or what payment do you want to stay under when we're looking at a property? And what I find is 2 things that distinctly are brought to the surface. And that is my clients looking well above their search value. And I've had clients look as far as even $500,000 above their search value. And it's hard because every area we look at typically does have a slight variance of whether the property is going to be at listing price, over, or particularly under listing price. And then I've also had circumstances where clients will be at their budget and then they want to drastically decrease or offer under that budget. And that's also very hard because, again, we're sticking with usually percentages as far as what they're able to buy within that area. It goes without saying that we do want to get you the best deal. We try to get you the best, but we also want to be very realistic in keeping both your purchase price and under your monthly payment in mind when we're really looking at both of those things. Number 5 is meeting all your timelines. The first timeline is the appraisal timeline, making sure that the home appraises at the contract that was written. The second one is your loan timeline. That's making sure that you're able to get your loan within a certain time period. The third is the investigation timeline. That's making sure that the home's in great shape, that you've reviewed all disclosures pertaining to the home and for the history of the seller living in the home, and also making sure that you're comfortable with any repairs that may or may not have to be made. And number 6, not reviewing all documents. It's important for you to review the documents as it is important for me to go through all of them as well. The old saying, 2 eyes are better than 1. We want to make sure that we know the home's condition, the history of the home, and more importantly, that you're going to know things to come that happen to the home as well. So we do want to make sure that not only am I reviewing, but also you're reviewing, and that we're both not missing anything that could be or could come up on the home.
And number 7, what I think is probably one of the most important topics that gets overlooked a lot is trusting your loan officer and trusting your real estate agent. Frankly, what happens a lot of times is that I will get on the calls, the initial phone calls after, Jared, you've sent them to me. There is a period of that call where I'm just asking questions about financial history, things like that. The one thing you don't want to do is not tell me all of the information, meaning you need to give me all of the skeletons in the closet so that I can figure out a way that we make sure that we present this loan to the underwriter properly. You can get into a lot of trouble when you don't tell me about history of, let's say, foreclosures or bankruptcies, things of that nature. Think of me like your priest or your lawyer is the best way to explain it. So you definitely want to have tremendous amount of trust in your loan officer, or you're going to run into issues down the road. So it's imperative that I know all the details of what's going on and what you're trying to do.
Also, what I believe is equally important is letting us know exactly what you want. If there are, reserves set aside for repairs, we are on your side. We don't talk to the other side. We keep things that are said to us confidential, and we make sure to always have your best interest, and we continue to have your best interest until the transaction closes.
One of the most common ones that in which client, not on purpose, they sometimes they just forget. Certainly I've done this in my own stuff where they forget that they have child support. They don't even think of it as something that needs to be counted it in the debt to income ratios. That can come up. And then certainly another common one, they're previously married and they haven't actually finalized the divorce. We have to make sure that the wife, on record anyways, has to sign off on that house. Certainly letting me know all of that history is going to be critical. So there you go. The top 7 reasons for blowing up a transaction.
Number 1, credit.
Number 2, transferring funds.
Number 3, changing or losing your job.
Number 4, unrealistic expectations.
Number 5, not meeting your time requirements.
Number 6, documents.
And number 7, not trusting your agent or your loan officer. Reach out to learn more.